We're back on Morning Mover. Shares of UnitedHealth rallying this morning on news of Warren Buffett's Berkshire Hathaway disclosing purchasing 5 million shares in the beleaguered health insurer. The billionaire investor previously owned just over 1 million shares between 2006 and 2009 before dumping the stake in 2010. Keep in mind, UNH was down more than 45% this year before today's move. Time now for Options Corner. Joining us to take a deeper look at UnitedHealth is Rick Ducat, the Duke of Data himself, our lead market technician. All right, Rick, what trends do you notice about this chart?
For, as you said, a beleaguered stock here. And if we were to kind of think about the healthcare sector as a whole here versus UNH, we can see UNH obviously significantly underperforming. It's one of these stocks that just kind of can't seem to stay out of the headlines here. We do have a more positive one today, but anyone who's been following the news understands. We can see healthcare underperforming the broader S&P 500 by a good margin, though, here. We can see if we look more closely here, this is kind of the breakdown of the healthcare sector. Equipment and supplies, pharma and drugs. Green is our general benchmark here. Then providers and services are struggling, but managed healthcare is the worst, partly because of United's unique situation, but also because of the sweeping cuts to Medicare as well that are projected in the GOP budget bill. So now to look more at UNH more specifically here, we can see that a really rough move to the downside here. We have recovered somewhat. We did recently make new lows beyond our previous low point that was established here. So a bit of a decline, but this rally here should help improve things significantly. We can see extremely heavy volume after that decline that we saw in the May, mid-May month there. We can see now as well that price is poised to retake some important levels here. We've got our volume profile point of control lining up with our 63-day exponential moving average near about 306. So if we were to look for an upside level, well, 376.84, that's the gap level that the bulls would want to fill here. If we were to move further to the downside, a break below 250 would be quite concerning, most likely for many traders here. Expected move, looking ahead, about 1.7% when I checked for today's expiration, 9.6% looking out to the September monthly here. That yellow line is our mark price, by the way, now, 298.80. That's what it's based off of here. So potential for some big swings.
All right, thank you, Rick. Now to take us through an example trade, we've got Tom White, senior options contributor. All right, Tom, so we're looking at these levels. It's got a lot of interest today, obviously, because of Warren Buffett. What's the approach for an example trade?
Yeah, implied volatility levels, even though the stock's still down over 50% from those all-time highs that we saw at the end of 2024, Diane, relatively muted at this point. So I wanted to look at a strategy. You know, it's not only Warren Buffett buying $1.6 billion stake in the company, Scion Capital, Michael Burry from The Big Short. He's in there. Third Point's also getting in there. So a lot of big hedge funds trying to take advantage of the pullback that we've seen in there. Implied volatility levels relatively muted at this point. So I went out to the September monthly cycle. So I've got 5 weeks until expiration in this one. So I've got some duration. We're probably going to see more people trying to get into this stock because it's so, downbeat from those highs that we saw at the in November of 2024. So going out to the September monthly cycle, so 35 days to expiration, we're going to buy the at-the-money 300 strike call. That's where the stock's going to roughly open up here today, up about $30 from yesterday's close. And then against it, because we want to still remain risk-defined and we want to offset some of the costs on that bullish call purchase, sell the 340 strike call. So a bullish $40 wide call vertical. We're going to pay roughly, the stock opens up here right around 300, about $12 debit, right? There's your risk, $1,200 per spread on that. And it takes your break even, you can see here, up to 312. That's only about 12 or 13 bucks above the current share price. So not even a big percentage move needed to get above that break even of $312 over the next 35 days on this one. So if you pay that $12 debit, that's going to be what you can, that's your risk on it. About $2,800 in potential profitability on this one if it gets above 340 on this one. And also, one item of note when you're buying verticals like this, I don't have to wait the whole 35 days till expiration. It gives me some flexibility as far as closing all or a portion of my trade. Say we get this stock moving up to 330, 340 over the next week or two. That gives you some opportunity to maybe close this ahead of time or at least close a portion of your vertical.
All right. Thank you, Tom. That's Tom White, senior options contributor and co-host of Fast Market with an example trade there for UnitedHealth.